Is the vibe shifting in the U.S. economy? We have the data on the Gray Report today. I am Matt Bosnagel, your host, joined by Jay Reeder, our Chief Investment Officer at Gray Capital, and we've got data on consumer sentiment from the New York Fed, also some insights into cap rates from CBRE, a look at housing from the Joint Center of Housing Studies, and another look at how immigration has affected housing demand and rental demand specifically from John Burns Research and Consulting, and a review of unrealized losses from lenders who may have been caught on the wrong side of the price declines in the commercial real estate market in the past couple of years. We've got a lot of data, a lot of research. I pulled in a lot of great stuff for us this week, and you're just hop on and join in, get into it, and we're going to take you on a ride here. Let's get into it. We're back in the Gray Report, joined again by Jay Reeder, the Chief Investment Officer at Gray Capital. I am the fill-in host, Matt Bosnagel, filling in for Spencer Gray and for another week while he is at the happiest place on earth, I think. Is Disneyland the happiest place on earth, or is Disney World the happiest place on earth? Well, he's pretty happy, I'm sure. We'll catch up with Spencer next week, but we've got a lot of stuff still to cover. Stuff keeps happening every week. That's what I'm always telling Spencer. And this week, we really benefited from, I think, a good sense of of what people are thinking about the economy. I kind of stumbled into it as I was taking my notes, but I want to start here with an article from CBRE talking about the impact of interest rate cuts on real estate cap rates. We spoke about a short piece from CBRE last week, and I think that and I know, at the risk of repetition, I wanted to cover the one from CBRE this week because I liked it. And I think that judging from the readers of the newsletter, they also liked it too. So, cap rates is always fun to discuss, because if not because no one's perfectly accurate about cap rates, you can see where they're moving, whether they're moving up and down, and CBRE expects them to move up a little bit next year, and I'll give you the specific numbers here in just a moment. So let's see. Let me pull this up, and we will transition. All right, let's go. Okay, so the title of this article from CBRE is "The Impact of Interest Rate Cuts on Real Estate Cap Rates," and it is an attempt to chart a course, I think, and set a series of expectations on where cap rates are headed, given that, hopefully, we're going to continue this interest rate cycle where interest rates are declining. Multifamily, I'm just going to cut to the chase here. Multifamily cap rates will fall by 25 basis points. That's 0.25% by the end of 2025. Industrial cap rates are expected to fall by 40 basis points, retail by 35, and office by 20. That's in this coming year. Ultimately, however, industrial and multifamily cap rates are expected to settle in at 4.5% for the long term. Retail at 4.6% and office at 5%. Now we can kind of, there's probably a handy chart here. All right. Yeah. See, so you can interpret this chart however you'd like. We've got it color-coded here, or I'm sorry, CBRE has it color-coded here, showing how as this 10-year Treasury yield decreases, so too do cap rates. And as cap rates decrease, property values increase. That's that inverse relationship. CBRE currently has multifamily cap rates at around 5.5%. So down to 5.25 down by the end of 2025, down to 4.5% again long term. And part of the CBRE's prediction here comes from a kind of schema or whatever, an analytical tool that they just give us for free, which is really nice. What they say is that a CBRE economic advisor's review of cap rates since 1995 shows for every 100 percentage basis point in the 10-year Treasury yield, cap rates move between 41 basis points for industrial, 78 for retail, 70 for office, and multifamily, 75. So the Treasury yields go down by 1%. The multifamily cap rates go down by 0.75%. That's essentially what they're kind of setting up here. And also worth remembering, they're kind of expecting a soft landing here for the economy. CBRE believes, this is a quote here, believes that the U.S. economy will avoid a recession as inflation continues to fall towards the Fed's 2% target. We expect that the 10-year Treasury yield will average below 4% for the rest of 2024, drift down to the mid 3% range in 2025. Treasury yields at that level will put downward pressure on cap rates as the lower cost of capital supports investment activity and asset values. It's a little bit of that's a long passage, but essentially they're expecting that soft landing. And man, a soft landing used to be a far off dream. I don't know about you, but I get a little nervous now talking about soft landing. It's almost hard to believe that, man, for so long we've been talking about soft landing, hard landing, no landing. We're building the plane as we're flying. All these metaphors that now we see maybe the runway in the distance, and I can't believe it. It's almost unbelievable. I think it's difficult to think about the soft landing because I'm expecting so many more bumps and scrapes to happen after all the bumps and scrapes that we passed through. So,
and I think one of the things to think about specifically, we talked about it a little bit last week when it comes to the soft landing, is maybe we have a technical recession. So maybe we actually have a recession, and we kind of do what all of the critics thought a couple years ago was going to happen. But what's the reaction to us hitting a recession? Is it like, hey, this is a technical recession, we're not actually feeling it, we're just moderate kind of growth, and it happened to happen, and we're not going to make any knee-jerk reactions, so we're going to kind of let kind of the policies do what it takes. So I think that there is a little bit of that in there where maybe we do see a recession, but hopefully people don't overreact and say, oh no, we're in a recession, and kind of overcorrect.
Yeah.
And so I think that's kind of where that soft landing kind of comes in, of hopefully they're preparing for that.
Yeah, I agree, and I think that a lot of it is going to revolve around the reaction and how quickly it's, because it seems like right now, and when we'll get into this in just a second here, it seems like right now, especially in the housing market, it's almost like they're finally beginning to feel the weight of higher interest rates. And maybe we'll see some price declines for home prices in the near future before the lower interest rates kind of kick in. But just one rate cut hasn't automatically vanished people's worries about the economy. That being said, those worries have been gradually lessening since peaking in a year and a half or 2 years ago. So we can just kind of skip right to...
And I think one of the things that we can kind of skip forward, but it's interesting. They say they expect the 10-year to average below 4%. Well, 10 years is not below 4% right now.
Yeah.
It's above, and we're getting into an election, and usually kind of going up to election is when you kind of expect that rate to come down for kind of sentiment for the election. With it not being below 4%, I'm curious what that kind of election day kind of line of demarcation does on the rates through the end of the year, because it's a good point. In the 3 to 4 weeks right now leading up to the election, I would think I would be seeing a drop in interest rates.
Yeah, well, the expectations okay, we can just go to this article from this press release. Some data from the New York Fed about expectations for things like interest rates, inflation, labor, a lot of different crosstabs, I guess. I don't know. A lot of different channels here that they're analyzing, and well, here's a question for the philosophers and theorists out there. At what point does a consumer sentiment become a consumer expectation? I think once you nail it down with the level of specificity, you got yourself an expectation. I think it's a little more specific. Take inflation, for example. We've got this data from the new survey from the New York Fed, and it says that inflation expectation is at about 3%. Now, I think that's a little higher than the past has shown. From CPI, all items inflation, 2.4%. Now, core inflation, which eliminates food and energy prices, is at 3.3%. But again, according to the New York Fed data, inflation expectations, the vibes, the sentiments, whatever, however you want to define them, they're at 3%. The Fed asked people in the survey, how much do you think inflation is going to be? And they put in 3%. That's what they did. Now, that wasn't enough for me. So I went to another data source, Conference Board's Consumer Confidence Index. They also track inflation expectations, and it finds consumers expecting, I'm just going to say it's a whopping 5.2%. So that's their number. Compare that to 3, bigger. So I went to another source, the third source, I only got 3, but 3 is still pretty good for consumer expectations. The University of Michigan's Consumer Sentiment Survey has inflation expectations at 2.9%. Now, looking at those University of Michigan numbers brings things back down to earth. But then I kind of dug into the numbers from University of Michigan, and they use the median for their inflation expectation number, and that's not the average. They're eliminating the outliers, but the average here is 4.7. So a lot of people in that survey from University of Michigan must have had some sky high inflation expectation, and it's almost puzzling. I don't know, Jay. Tell me, what could affect people's sentiment so much that they're making these crazy high predictions for inflation at nearly double the rate of inflation of 2.4%? I don't know what is going on right now that could possibly affect people's opinion of how the economy is going.
I think the biggest thing is, as you said, it's perception versus expectation. And everyone has heard for 2 years, inflation. Well, when you hear something enough, you assume that it's correct. And I would say for a lot of people, things got expensive enough and out of their reach, whether it's housing, whether it's food, all of the items in the last 2 years. Well, if those items are still out of reach, you probably think it's the same thing's happening now that was happening then. Now, maybe it's not growing as much, but you still can't afford it the way you used to be able to. So your expectation is that it must just be growing at that same rate. As opposed to it's staying flat and you just haven't been able to catch up to it.
No, I think that's valid too. I also think the election. That's what I was really searching for. But no, I think that you're right. That's the sensible, reasonable answer. My quick hot take answer was that the election is fueling a number of people who it's in their best interest to like scream at the top of their lungs about inflation getting out of control. And that also motivates individual bias at the same time. So we're in this marketplace of information where, it pays to have this outsized expectation for inflation from one side. And I also think that the other side, so the Republicans, they're incentivized to say that inflation feels worse than Democrats, where Democrats have not been quite as vocal as saying that everything's okay.
That was going to be what I was going to say is I think you hear that from one side, and then the other side, you're not hearing the rebuttal of, no, it's actually okay. And so when you don't have that, it's, well, is it okay? Because you would think if they had that data that says everything's okay, you're not. And I think that goes back to what I was saying of maybe it's okay from a numbers standpoint, from a 2%, but they know that it's still unaffordable. So when it's still unaffordable for people, how are you going to tell them it's okay?
No, that's a really good point. And I was also looking at the past to the difference between, now I don't have the Michigan numbers up here specifically, but I was looking at how the mean, how this average was different from the median over time. And right now, and like proportionally, it seems like we are so way off. Like the average is almost, it's almost like 60% higher than the median. And that wasn't always the case. Usually they're a lot more closely aligned, but this time, man, there's some outliers. Particularly, I think, given that 4.7 as the average compared to the 2.9 as the median, a lot of people are overestimating. Well, maybe not overestimating because we don't know what's going to happen. Maybe they'll be right. Maybe the feelings are right. But to return to these numbers from the New York Fed, the trend that's getting media coverage here about the New York Fed data, as much as it got coverage, the Gray Report, it's getting coverage elsewhere. People are talking about how there's been a market increase in expectations on missing debt payments, whether it's credit card payments or loan payments. It went from 3.6% to 14% in September. So this is the highest it's been since April of 2020. And April of 2020, if you recall, low interest rates, high amount of uncertainty. I think peak COVID chaos. And so September 2024, in contrast, high interest rates, and maybe there could be some economic uncertainty as unemployment expectations are trending down, actually, and earning expectations are actually trending up, according to this New York Fed's data, actually. So it seemed reasonable then to assume that people are feeling nervous about keeping up with debt payments because they're still under this pressure of high interest rate payments. And that's why I was kind of alluding to that when it seems like maybe there's some cracks forming, maybe there's some pressure of high interest rates. That it didn't always, that the relief didn't come after just one rate cut.
And I think looking back, I'd say here kind of at Gray, we've been tracking this going back 18, 24 months, back when, Matt, you had done your research on kind of potential delinquencies coming in multifamily. And kind of one of the things that we also saw at that time was the outstanding balance on credit cards. And that was kind of something that we correlated with people's ability as consumers to make payments. Therefore, if they can't make those payments, are they making their housing payments, which then affects people's ability to pay rent and all of those things that kind of then trickle up to our industry. So we had been watching that. So like you said, those balances were high, but payments were being made on time for the most part. And now we're starting to see that. And so is that kind of balloon coming where all of a sudden, like we've had these growing interest rates, we've had growing rents to offset that. Now some of it's, hey, it was COVID and all that. And we talked about last week, like, did people grow too much? Yeah. But I think now we're kind of, as you said, kind of feeling that pressure from all sides, whether it's consumer spending, whether it's on the business side. I think we're just kind of starting to see that. And I don't know if it's going to be cracks. I don't know if it's going to be fallout. Yeah. But it's something that we just all have to kind of keep in mind. Yeah. And
we are real time watching the lag between the Federal Reserve interest rate decisions, or, the 10-year Treasury, and like the reality of people. And they're not as forward thinking as, the investment class or the people that are in the bond market or the people at the Federal Reserve. Yeah, they're more dealing with the past and the accumulation of that stress that they've been under this high interest rate.
Yeah, I mean, if you have a $10,000 credit card bill, are you not going to spend that $100 because your interest rate is 2% higher? Or are you not going to spend that because I don't have $100 to pay it?
Yeah, very true.
It's a very different catalyst of why you're making that decision.
Yeah, totally true. Also, let's see, interest rates expectations, by the way. Now we can use, I'm going to put this on the full screen here. Interest rate expectations are on their way down, and I'm going to go into this inflation, labor market, household finance, I believe is going to be where it is. And expectations, debt delinquency, household spending, income growth. Well, I guess I was wrong here. Expectations of higher interest rate on savings accounts, that's a little bit lower. Debt delinquency, that's the one that's been ticking up. You can see that big spike. It's actually been ticking up since May of this year from where it was 12, and now it's at 14.2. I think that we've got one from University of Michigan that shows that the interest rate expectations are actually coming down as well. These are all positive numbers. They're all good signs, and they've all been kind of gradually getting better since 2022, 2023. It hasn't been, snap your fingers this past September, everything's great because of the rate cut. It's a result of this long slog from peak inflation, really. And what I think is interesting is the negative feelings were much more seemed like came from inflation than interest rates. We're feeling interest rates. That's a big part of our job. But day to day, it's easier to think about the high cost of eggs rather than this abstract idea of an interest rate that's 1 measly % higher than it is.
And I think where that really comes to fruition is kind of the bifurcation of, like you said, the day-to-day spending and housing. Because yes, we have interest rates on credit card, but no one's making any sort of decision on spending based off of your credit card interest rate. You don't think about it. They send you your notification, hey, your interest rate is changing in the mail, and you get those notifications, but it's not like, oh, I'm not going to spend this, because I think in everyone's mind, it's like, well, I'll pay it off. So you're not making any decisions. Where it really comes into it, where people feel it on a day-to-day basis, is housing. Because on a mortgage is kind of on day-to-day, the only time that really interest rate affects your buying power, maybe a car as well. But those big purchases that you're only making every once in a while. And so I think that's kind of why that bifurcation exists, because it's this difference between how you spend your day-to-day life and a decision that you're making once every few years. Yeah. And all of a sudden, that's the only time that interest rates are affecting your decision making.
Yeah. So I try to find a big, beautiful chart for these interest rate expectations, but I did get the numbers here. I recorded the numbers in my notes, but I didn't draw the chart. There are now 25.1% of people are expecting higher interest rates, and the converse, so that means that around 75% are expecting them to stay the same or go lower. It's a sign that people are expecting them to go lower. I'm using this higher expectation for some parity in comparison with the University of Michigan survey, which also very close numbers, has 24% expecting higher interest rates, down from 28% the month previous and down from a peak that was hugely high. 88% thought rates would go up in April 2022 in the University of Michigan survey. The peak for the New York Fed survey was 35.7 thinking that rates would go up. So I don't know what the difference in methodology there, but again, there was like this huge certainty, and I would be certain that rates were going up in April 2022. High inflation, that's all they were talking about. Of course, it would go up, and I just wanted to note that that's what the numbers are saying, and I also think that and maybe it's a logical leap that it's easy for us to think of between inflation and interest rates. But I do think that if people are thinking that interest rates are going down, then maybe they're also thinking that inflation is going to go down too, or at least stay down, because 2.4 is nothing to sneeze at. It's fine. I think that Jerome Powell has a sight set on 2%, but 2.4 is not bad. But yeah, sorry. Getting so far into this topic of consumer expectations, I don't want to lose sight of our overall focus on gray capital and connect this back to the apartment market. I think that it is, it's always nice to get a source on where interest rates could be headed, whether that's from like the teeming masses and their consumer sentiments and, this is unreliable sentiments, or it's from like the educated guesses from people. It's worth still taking time to review what are really like deep numerical studies that have gone on for a long time. Like the University of Michigan study has been around since like the 70s, I think. And this New York Fed, you've got like decades of information, and the Conference Board as well. They're all tracking this stuff. They're all giving it to us for free. And you can compare, contrast, like combine. That gives you a pretty good sense on what people think about the economy. And I don't know, maybe it's cocktail conversation. Maybe the next time you see someone talking, maybe during Thanksgiving when people are like, oh yeah, people think the economy is terrible, you can butt in and be like, well, actually, the data says this, depending on how.
Oh, so Matt, you're going to be that guy.
I know, exactly. I was like, well, maybe I don't want it to be the actually person, but it is this useful snapshot. And sure, it's an inexact measure of feelings and sentiments, but it is. But like that's what people are feeling at the same time. I trust that people are feeling that. I trust the methodology of these studies. And say what you will about people's feelings, that the feelings are the start of what motivates investors to buy sometimes. So these people, some of them maybe are institutional investors, or are the experts that are also making their predictions and on CBRE articles or whatever. So I love this. I liked getting all this data together. And again, if I can fuel some cocktail conversation ammunition, then all the better. So we can move to this next article from the CBRE, which is talking about if big deals are suffering more than smaller ones, or kind of what deal size are the ones that have had more activity or less activity in the past few years. Now, all of them have had less activity, but the question is which size of deals suffered the most. And this is a short article from CBRE, really more of a chart. It's their chart of the week, by the way. And it measures how much did CRE buying and selling go down between 2021 and 2024, separated by the size of the deal, in this case by quartile. So the first quartile, the smallest, the fourth quartile, the biggest. Maybe it's 300 to 500 units. They don't give us the exact number. I was talking to Jay about this before, and it's frustratingly enough, they did not. But they do give us a sense of, let's see, the biggest deals went down the most for office and industrial, but for multifamily, the second biggest deals went down the most. That stood out to me, but CBRE themselves actually call attention to the gap between like the biggest deals and the smallest deals. For instance, office had the biggest gap. Office sales activity went down 15% more for the biggest deals than the smallest deals. Multifamily had the second largest gap at 9.1% compared to 7.3% of industrial, and retail, it seems like kind of all over the place. There was really hard to get a correlation, but their gap was a little bit smaller as well. For multifamily and retail, also it wasn't this. Again, like I said, it wasn't this case where it's a easily descending line where the biggest deals had the biggest losses and the smallest deals didn't. I've got a big question mark. Like, I'm wondering why this is. Why is it in multifamily that the second largest deals were the ones that fell off so much between 2021 and 2024 compared to, the biggest?
I think it has to do with volume, because if I'm guessing, I'm looking at that second quartile, and I'm just throwing here because we don't know the numbers. I'm thinking that those are probably apartment communities that are, call it 100 to 250 units.
Okay.
That is the largest amount of stuff that traded in 2021, 2022, 2023.
Yeah.
Like, that's just where everything traded, because that's where people kind of saw, hey, there's enough scale to buy a community. I can make that jump from being a scattered site person to doing it. But it's not quite big enough that I need that institutional money. So there were a lot of people, and there was a lot of deals being traded in that area because there was money available. Consequently, there's a lot of investors in kind of that kind of class of people that are very sensitive to returns. So if a lot of those deals traded and interest rates go up and they can't get the price they need to hit returns, they're going to hold on to that property.
Okay.
So it's not going to trade again. And so that's probably why your volume went down, because that number was so high beforehand. And I think we talked about it last week.
Yeah, it's like the deals aren't there.
Yeah.
It's the people getting the deals out there. It's not necessarily investor appetite. That's a really good point. And a good reminder that it's not necessarily deals going down. It's also the factor that, you got to look at how much the deals went crazy up in 2021 if you're going to make this comparison.
Yeah, so there was just so much deal volume that it was going to naturally revert to the mean, because we're not going to trade, call it 30% of the inventory. I'm pulling a number out there. You can't trade 30% of a housing inventory every single year. You'd be trading every property within a 4-year period of time.
Yeah.
And so you just can't do that. And so we traded so much property kind of in that 2021, 2022 range that anything below that was going to be a drop off. And then with rising interest rates and not being able to finance, the couple deals that did come out, well, it naturally said that your volume was just going to go down. And I think from a standpoint of that second quartile specifically in multifamily, I think it's because there were so many of those that it's more than the larger ones, because your larger ones, there's only a select group of people that can pull those deals off.
Yeah.
They just have access to capital that is different than the rest of the market. And so those deals probably didn't go as crazy because there weren't the buyers there during the frenzy, and haven't fallen off. They've still fallen off, but not as much, because there just aren't buyers for that kind of deal, because trying to raise that kind of money for those deals just isn't there.
Yeah. No, I think that makes a whole lot of sense. All right, I want to move into the housing market now, and talk a little bit about this article from the Harvard Joint Center for Housing Studies, where they go into 10 major housing stories from the latest Census Bureau release. It is the American Community Survey, one of the most important resources for housing researchers in the country. And again, this is just stuff they're giving away for free. And it's good data. I think that Harvard Joint Center for Housing Studies always is they're keenly aware of the housing affordability crisis, and so we're going to get at it from a lot of angles from the Harvard Joint Center for Housing Studies, and that's the number one thing that they want to pull out here. The first on their list of this 10 is increasing housing unaffordability. More renters than ever are spending more than 30% of their income on rent. They have their data says that this group increased by 226,000 from the previous year. Now, I did a little bit of the back of the napkin math, and that's about twice the rate as before. If you're going kind of proportional to the population, and if you're looking at population growth at the time, which was 0.5%, if you're taking 22 million and multiplying it by 0.5, then you're going to get like 110,000, and now we've got 226. So they're growing by roughly more than half the rate. And as we may discuss here in a moment, part of this could be due to immigration. Their second point is that rent growth has outpaced income growth. And I think I agree if you're including the peak rent growth from a few years ago. If that's your start and stop point, then that is valid. However, it may be a little bit different nowadays, and it depends on what data source you're citing for rent growth. I think it's fair for them. They're probably citing the CPI, rent of primary residence number, which is still around like 5% now, and that's probably higher than income growth. we have criticized that 5% number, or the CPI number of rent, because it lags behind the market rent for new apartments through the other data sources we get from like RealPage, Yardi Matrix, Apartment List, whatever. However, it does represent what people are paying at any given time. It's just they're not making decisions on the market at the moment, but like they are paying it. So this is valid, although like there is a case
to pay it, not necessarily paying it.
Yeah, that's a good point. Yeah, as you made that point last year, or last week, is what did you say that people are seeing more delinquencies, and that may be because rents were increased a little bit too crazy before. So yeah, definitely a valid point here, and a sign that maybe we could see continued sluggish rent growth in the coming year. I think that their third point, homeowner affordability challenges, that's like kind of similar to what we just talked about. Expense growth, that's a little bit more explicit here, and I like this idea, and we kind of touched on it when we were talking about consumer sentiment as a factor in like rent growth or apartment decisions. Like there's a lot of people that they're not just paying for rent. If we are looking to see where rents are going, how much demand there's going to be for a rent at X price. If they don't have any money because eggs are a bunch of X just costs a whole lot, then that's going to impact their capacity to pay the rent. Doesn't matter really what the other things are. If inflation is eating away at all the other expenses, and these expenses isn't just groceries. They're talking about taxes. It's utilities. It is insurance. There's a lot of things that are making things harder to pay for now that maybe were a little bit less of a pressure pre-pandemic.
And I think the biggest thing to think about when it comes to these items is savings. Like when you put on here mortgage, taxes, insurance, all that. Well, in order to get a mortgage, you have to have savings.
Yeah.
If people don't have savings from the last 2 years because the price of everything else has gone up, where are you going to come with money for a down payment?
Yeah.
And so I think it kind of continuously fuels that perpetual cycle of where's the money coming from.
Yeah. And one rate cut is not going to make it. It's not going to make it that much easier.
Yeah. One rate cut doesn't all of a sudden put money in those people's savings accounts for a down payment.
And we've talked about that. To get in a little bit of the political. So one of the Harris campaign has mentioned like I think it's $25,000. They want to give to first-time home buyers, and the critique is that that's just going to increase home prices by another $25,000. If I was a first-time home buyer, I'd want that $25,000. I would not care about home prices. I'd want that money. So that's my perspective on it. Is that like yes, there is definitely an argument that people could jack up their prices by $25,000. There's probably a little bit of lag time you could take advantage where that $25,000 is going to go a little farther than you think.
Yes and no, but at the same time, where that has to go is supply has to be there. And
no. The underlying idea is definitely like it's going to increase the prices, but like I also, from a practical standpoint, there's probably a little lag. And like if I was a first-time home buyer, I'd much rather have that money than not.
You would think there might be a lag, but think about this. Think of what percentage of people in this country have a mortgage interest rate less than 4%.
Yeah.
And what the values of houses are. And I think we talked about it this week. Like, what are you trading out of?
Well, but this is first-time home buyers.
Yes, but I'm saying the people that have to sell those houses.
Oh, they'd be really motivated to tack on that $25,000
because they have to then go buy something, and then they're competing against people that are getting that $25,000.
Oh, it's helping the existing home buyers. That's funny. Okay, all right, yeah. No, that's really good logic. I agree. And so just kind of going along these 10 points again too. So we've got the expense growth. We've got the insurance growth. There's less home ownership, slightly by a younger population. There's a slight gains in Black home ownership. And now we're at number 7. Household growth is slowing from its torrid pace, but it does remain above average if you're comparing with the 2010 to 2019 household growth. So that's positive. I've talked for the last several weeks about, or probably years, about the strength and longevity of housing demand. I think that housing demand is going to continue as this wave of additional apartment supply continues. So that's very positive. And following that as a source of this housing demand, there has been more immigration in the past few years. We're going to discuss this really soon in this article from John Burns Research and Consulting. But immigration, there's an argument to be made that had a measurable effect on housing demand and specifically on rentals. Not a transformative demand, but one that is, I think if you're living in a city that typically sees a lot of newly arrived immigrants, and that's like kind of a destination for newly arrived immigrants, then I bet there's some competition for apartments specifically. And you mentioned this before the show, specifically not for like the luxury apartments, but for the B and C class apartments that are scarce. They're scarce now. You can't build one and make it B class. Usually they're building A class apartments, so there's this hole in the housing market that's difficult to fill, and that pressure, that demand there from immigration is making things probably difficult for when it comes to looking for that kind of housing. And then finally, the last two, single family rentals increased. I think that's really totally makes sense with the aging of the millennial population. I know that's a gross oversimplification, but going from the University of Michigan data on consumer sentiment, I'm gonna give myself a little bit of time to speculate and say, in the stage of life of millennials, they're going to maybe go and start a family. They want a little more space. They want a yard. I've always been interested in. So right now in the campaign, Harris is talking about, and she's not wrong about how owning a home is a way for a lot of Americans to build wealth. And I think that is typically associated with like the American dream of owning a home. Well, is it owning a home or is it living in a home? Like if you rent your home and maybe you got a good landlord that allows you just to rent for long term, and you're willing to pay rent, is that any different? Probably can't like make any renovations without talking to the landlord. You don't have as much control, but how much is it where you live, and how much is it the fact that on the balance sheet it's yours and not the landlord's? I think that there's probably a big thing, that's probably a big deal to a lot of people, right? You want that the spirit of it's your home, it's not the landlord's home. But I also think you live in somewhere a long time, whether it's an apartment or a house, even if you're renting it. That does become like a part of your identity. It becomes part of who you are. You take care of it, and you're attached to it. So, I don't know. Maybe conceptually, if people can get over that or not. But my point is that it may, because of the way that there's very little single family home. There's little declines in single family home prices. Single family home prices have gone up significantly, and significantly more than apartment rents, which that's what everyone's complaining about. They're complaining about the algorithms changing the apartment rents. They're not talking about how home prices have increased sky high compared to even apartment rents. And
I think that goes back to what I was saying earlier. Two reasons. One, supply, because no one's moving, so you old supply and demand.
Yeah.
But same thing is, if you're going to sell your house, you have to buy something else.
Yeah.
So you have to be able to cover your costs to do that. Well, the only way to do that is to sell your house for more. And hopefully when you buy that next house, you're getting what you need at maybe equal money.
Yeah. No, I agree. And it plays into this line at the end of this John Burns article about like there's just a need for more investment. And it's not, and you can think of it as like investment. You're going to make a whole lot of money here, or you can think of it as a community investing in more housing. Whether or not this is driven by fat cat greedy people or by people that are investing in the capacity of a community to have housing, you could that's fine if you want whoever you want your enemies to be. But the fact is, there's money that needs to be spent on housing in these places in America, and like that's not going to go away. There's a lot of things that are pointing to that, and investment would help to solve that problem. Because it would help create additional supply. It wouldn't, we're not talking about turning up the volume on rent or anything like that. We are talking about the need for more of it. Now, they also say, just to kind of close this out from the Harvard Joint Center for Housing Studies, they say that remote work is here to stay. I think it's a really interesting point, and I wish that I swapped 9 and 10 so that I could have a good segue to the John Burns Research and Consulting article. But this remote work, their point in the Harvard article is that, yeah, it's at 13.8%, which is down from the peak of 17.9%. But pre-pandemic remote work was only at 5.7. So it is still quite elevated, and it's far closer to the peak than it was to the pre-pandemic point. Things may settle at maybe 10, maybe they settle at 12%, at twice as much as it was before the pandemic, but it's not going away.
So, I guess since I don't know where the kind of idea of it is coming from, is that companies that are work from home, or has there, since COVID, been a shift to the gig economy, which is then more a work from home type demographic?
Yeah. That's a good point. I'm not sure, but the implications that they draw here, that Harvard does, is they're saying that it allows people to live in more places and live in more different places, but it also dictates what remote workers might need for their housing, like additional space for an office. We've talked about that a couple of years ago in the peak remote working, how apartment size was getting bigger, house size was getting bigger. People were looking for like the teleconference room or whatever it was, the Zoom room. And now maybe there's less of a need for it, but it hasn't gone away. And I'm sure that apartment builders are still thinking about that when they're designing. Do we need a Nook for a Zoom call? I don't know. Maybe it's a Skype call. Maybe it's Microsoft Teams. All right, let's get to this John Burns Research and Consulting. It is on immigration. We have talked about it a couple times earlier in this episode, but without further ado, we'll show it here. Their point is, and this is there, slowing immigration is set to give a smaller boost to housing. The implication then is that it gave a big boost before, and now it has given a smaller boost. Immigration surged in 2022 to 2023. You really see in this graph here how much it just ballooned in the years, so specifically in 2020. Yeah, in those 2 years, 2022 and 2023, more than double it was previously, and that has had an effect on housing demand. Specifically, elevated immigration from those 2 years has resulted in 700,000 additional households. That's more households that we would have had otherwise, and 600,000 of those were renter households. That's their estimation, and I would agree, these newly arrived immigrants are much more likely to be renters than they are to be homeowners. Pre-pandemic, we were building, now this is just to compare, and that's what I wanted to know, is like, okay, so these immigration numbers, how does that actually compare, and how would that, what kind of splash would that make on an apartment market and on the apartment market nationwide? Well, pre-pandemic nationwide, we were building 300,000 to 400,000 new apartments every year. We had a couple of years where we were building $200,000 to $300,000 more units than typical, like this year and last year. This year, the estimate is like 645,000 new apartments are going to be built. That's a CoStar estimate. Last year, we had 600,000 built. So that's like 200,000 to 300,000 more than the pre-pandemic typical number. So we're kind of coming close to that 600,000, but we're still not. And it still compares like that's still a lot. Actually, we're talking about peak, the highest amount of newly built apartments in 40, 50 years. So 600,000 to add that to a pool of apartment renters, that's got to make an impact. Again, like I said, maybe not transforming, but it is measurable, and it is worth thinking about if you are in some of those markets where there's a higher immigrant population, where immigrants typically move to. I looked it up. I was looking, it's like California, Texas, New Jersey, I guess, too. There are places where people can maybe expect, and maybe that's where a lot of building is going to come. However, like you did mention, and I think it's a really great point, the immigrants are not going to come in and look for Class A newly built apartments. The demand is going to be in the B and C class apartments that they can afford. So I'm really interested to see how that shakes out. I don't know what your take is on it, though.
I think I kind of mentioned to you a little earlier, I think where it kind of creates some pressure is on kind of the existing workforce housing renters. Because like you said, if that's where a lot of the draw is going to be, we all know that we're underserved on affordable housing. So to sit here and say that affordable housing is going to absorb all those people, it's just not going to happen.
Yeah.
That's the dream. That's the nice way to think about it, but it's just not going to happen. There's not enough deliverables of capital A affordable housing.
Yeah.
So it's going to come in that workforce housing that's kind of lowercase a affordable, where it's affordable. Everyone kind of knows it's workforce housing. You're never going to get top dollar there, but there's going to be so many people that try to live there that those rents are going to creep up. Mm-hmm. Now, who does that hurt? Does that hurt the existing renters that can't pay it anymore? Does it hurt the immigrants who are coming in and maybe not have the funds to be able to do that?
Yeah.
But what it's going to do is it's going to do one of two things. It's either going to push rents in those communities up, or it's going to push those renters to say, hey, I've got to go move somewhere. And it's going to kind of move people up that scale of apartment communities. And I think that's where I've talked to on here about is people will go move to those because that's where they have to go. Like they have to live somewhere.
Yeah.
But can they pay for it? Mm-hmm. And it's whether it's at that community, as the rents go up, can you pay for it? Is it, hey, I'm going to move here and go from a class C to a class B minus, because if I'm going to pay the same amount, might as well get a little bit nicer, but I still can't really afford that.
Household size probably going to increase.
And so then as your household size increases, if you, like we have a community that has primarily 1 and 2 bedrooms, that services like people that are kind of working at the logistics stuff in the area. But as they have families, as they have kids, if you have multiple family members, living in a 1-bedroom apartment is a lot harder. And so then you kind of are moving to one of those places that has 2s and 3s.
Or if you're, I'm also thinking struggling college students that get roommates will get roommates too. And then, that's a thorny issue. And there was articles even from the Harvard Joint Center for Housing Studies and elsewhere about whether it's middle income housing assistance, some of this stuff that they were talking about, but there was also this idea of like we have to increase somehow the supply of more affordable apartments, and I haven't yet read about a really compelling plan, or even just like a single project where like, all right, we built this for this and it's repeatable and we could do this elsewhere and it makes sense for the builder and for the people funding.
The closest thing is LIHTC housing.
Yeah.
And so tax credit housing, that's the closest thing, and it's been the most successful thing that we've had. But it really is hard on ownership. It's great for developers. When you develop these properties, you get money up front, but then these properties are basically run at break even for 15 years. It's really hard to reinvest in those properties. And so kind of when you get to the useful life of your systems in there, your HVACs, your refrigerators, your roofs, all those things, it's really hard to reinvest because you're capped at the amounts of rents that you can charge. Like they were designed and incentivized people to build them, but they're not designed and incentivized for people to maintain them.
Let's do that. Let's get that government money on the maintenance.
and so that's where it's really, really difficult. So there's a lot of people that want to get into that space because you can be very successful developing them, but it's very, very hard to continue to own them because there's just not enough rent coming in. Because unlike Section 8, way back when they did Section 8 housing, which basically said, what's the market rate in here? People are going to pay 30% of their income, and then we're going to give you the amount of money to kind of offset that. It's really, hey, this is the max rent that you can charge. Don't care what your expenses are. Yeah. This is the max amount that you're allowed to charge. And so it really is hard on the ongoing maintenance of those properties. And so the other thing with those is it's a very competitive process to get the credits to even build those. And so to get those allocations is very, very competitive. It's not like, hey, I want to build I want to build this, give me the money for it, give me the credits. Like it's very competitive. They only have so much that they can give each year. And so you can only supply the amount that there's money available to do that. And so that creates a bottleneck too on those affordable units.
That's what I was wondering. I was wondering what the pool of cash it was for some of these like LIHTC houses, and how, where the gap is, right? Is it a gap because people don't want to build? Is it a gap because the government doesn't have enough money, doesn't have the money to build wherever,
So within the tax credit housing, there's 2 types of tax credit housing. There's 4% and 9%. 4% are, they call them like non-competitive, but I've even known in Indiana a couple of years ago, there was so much demand for them that Indiana actually ran out of money for it and actually had to like kick some projects a year in order to do it. And so 9% are the competitive ones. But 9%, like you almost have to develop. You can't, 4% you can either develop or you can rehab existing properties on 4%. But because of the economics, it really doesn't make sense to build new with 4%. It really only makes sense to renovate with 4%. On the flip side, 9, in order to get the points that you need in order to qualify on the competitive side, you almost can't rehab. You have to build new. The problem is, in order to make the financing work on it, they have this like these scorecards and these points that you can do. Well, you kind of max out at points at a certain size. Like that's why when you see these units, a lot of them are like 60 units, maybe 100. Yeah, there's no incentive to build more than 100 because you don't get more points for doing it. And then all of a sudden your economics start swinging the other direction where it's untenable to do. So it's like, I can't afford to.
That may be by design.
And so that's the other thing is it's a competitive area, but when you're developing these 9%, you can only build like 100 units at a time with it. You can't build 200 units of affordable housing like you do when you have a 250 unit market rate that gets delivered every year. They're much, much smaller deals. And so that makes it very, very difficult to scale large when it's competitive. So all the people that are even proposing these deals can't even get the funds for it. But then even once they get the funds, they're very small communities.
That's interesting. That's really interesting. This is what you kind of dealt with this a little bit in
my past life.
I maybe you need to be the guest on the special guest on the topic of affordable housing, because we talked about, Spencer and I talked about that too. It's like, man, because I was wondering too, I said if it's by design that these projects are kept small, because I know, every time you mention that you're going to build somewhere, you get the NIMBYs coming out of the woodwork and saying, no, we don't want it here. And so if you're limiting the size of that, then it maybe makes it easier to slot into where
a lot of people have kind of circumvented the system for that is with the city and approvals is it's not tax credits. Like you're not necessarily getting tax credits anymore. You get a new market rate development, so you can afford to build a bigger community, but you have to set aside a certain number of your units to stay. And so there are municipalities that are requiring that, which helps. It creates a pool, but it also kind of offsets the money that you need to be able to run the property well. And so there are some things like that. And I mean, I know enough to be dangerous on affordable. I probably would not be your best guest. I could find you a lot of people that would be much better, but it is definitely something that
I'll be in touch. we'll be in touch with your booking agents. All right, let's move on to this MSCI article. It's another one where I think that you're going to be a lot more informed than me, because and at Great Capital, we're not lenders, we're investors. We use lenders a little bit. So I wanted to shed a little bit of light on the lending side here and maybe learn something in the process. Now, I have here on the screen, I'm just going to kind of cut to the chase here. This is about collateral losses. So basically the relevant quote on this article here, and this is the title of this is "The What and When Matter for the Losses of Real Estate Lenders." And the quote is, "Lenders who originated loans late in the cycle, such as debt funds, tended to have larger unrealized losses on the underlying collateral. The lender group that stands out is the investor-driven group, a category that includes debt funds and other financial lenders. Banks in general also originated more loan volume later, which is 2021 onward. The pain, as I'm reading it here, is in the form of these decreasing values for assets bought at the peak of, CRE price fervor right before it went, all the values for everything went down. The buildings that these people got loans for, I think, I could be corrected here, these buildings got to be worth less money. And so that means that the banks are a little underwater or have these unrealized losses. Like they're not losses if they can wait long enough for prices to go up. And that's my question. That leads me to the end of my notes here is how much is price growth? How much price growth is needed? So we're looking at a graph right here that shows a bunch of unrealized losses for loans that were started in 2022 and 2023. So how long until all these losses break even or get back? And is this a crisis?
No. So what I would say on that is yes, it has. I like how they kind of framed it here as like what and when matter. And I think the reality is everyone's collateral went down. It doesn't matter if it's like a bank. It doesn't matter if it's a debt fund. It doesn't matter if the agencies, whatever. Everyone's went down of the underlying amount because we know that pricing. Now, anything that traded, sorry, not everyone's value, but anything that traded, it went down in price. But it really matters. This is where kind of the risk mitigation on the lenders matters a lot. And how was it levered? And the reason they probably called out debt funds and banks here is they oftentimes collateralize shorter term investments. Like typically when we go and we were getting size, like if you wanted to do a value add, it was a lot harder to go get agency because you were locked in for 10 years. So you were bringing a ton of money to do the rehab, and then you were only getting 65, 70% loan value. So you were bringing a lot of money. So it was hard to kind of push your returns. So you got a loan that was a little bit higher and a little bit more aggressive, and you use that money from the loan to do it. But that means that you were probably getting some 80, and I've heard stories on debt funds of like pushing 90% of your cost at your loan. Well, then all of a sudden,
really 90%
on some debt funds because they were giving you money for the rehab, and so they gave you a principal loan of, call it 75% of your loan, but then they funded your rehab because they thought that the value of your property after you did the rehab would stabilize, and it then would level out to be approximately 70% of the after renovated market value.
Okay.
And so they sized the loans to that after renovation sizing.
Okay.
Agencies couldn't do that. Yeah. Agencies had to be very, very strict of like, this is our 60, 65.
Our debt funds have higher interest rates though, usually?
Yes. They're floating because with debt funds, with like a bank loan, a lot of times what it is it's like a 2-year bank loan with like 2 1-year extensions. And so when it's short term like that, they have to go based off of SOFR, or at the time, starting in 2020, it was LIBOR, then they transitioned to SOFR.
I remember that.
And so you were kind of locked in with that. And so a lot of times your banks were 2-year bank notes with 2 1-year extensions.
Okay.
A lot of your debt funds were 3 years with 2 1-year extensions. So they kind of looked like 5-year, but you kind of had this retesting every year of, are you hitting your debt service coverage ratios? Are you kind of hitting all of these metrics? That could basically kind of put you in technical default.
Yeah.
Agencies, it's once you're locked in for 10 years, your interest rate's not moving. And so interest rates going up didn't matter for those people being underwater because their payments aren't going to go up.
Okay.
And so that's kind of where it happens here with a lot of these is, if you're at 90% of value, if you're levered at 90% of purchase price and the asset goes down 10%, the debt fund could take it and still break even. They're not going to make a ton of money, but they could break even.
Okay.
What happens is when you are levered more than what that reduction is, so like let's say 20%, the value lost 20% of the value. Well, if you levered at anywhere between 80 and 90% and it lost 20% of its value, you're underwater.
Okay.
And so that's where the struggle games. Well, then what happens is as short-term interest rates went up, if a lot of people had caps on these properties, but even though they had caps on it, they had to fund these cap replacement reserves. So money that would have been going to make the property more valuable now is getting taken out of that and being put in these reserves. So now the property market is telling it's going down 20%. They're not doing the rehab, so that post-stabilization value is not there. And people aren't able to make their interest payments because they're running out of money.
Makes me wonder why there wasn't a spiral in crisis for some of these.
And that's what when you talked about the loans, like that's what happened, and that's why there was that concern. But what's happened is people didn't want to take these markdowns, and so they've given a lot of extensions.
Oh, okay, yeah, that's what the Federal Reserve was issuing that guidance. I think last year was like, give them a break, and if they ask for another break, give them another break.
and so that's kind of what you're seeing is if they take them, giving them extension, they don't have to take the markdowns on that. They can take these as unrealized losses as long as they're continuing to make their payments.
Okay.
If they're able to continue to make their payments, they're probably not going to foreclose. They'll probably continue to extend.
Yeah.
But if they stop making payments, that's when they can kind of force the issue. And that's where it's, okay, how much has the property lost value? Now, again, with your banks and with with your agencies and like HUD financing, like a 223F or like a Fannie or a Freddie, it's locked in for at least 5 years, probably 7 to 10 years, because if you bought, rates were at a point where it made sense to do that.
Yeah.
So you're locked in they're not really looking at that change in value. It doesn't matter because you have time to weather it.
Okay.
But those short-term bank loans and debt funds, those are the ones that really struggled because they were levered so much more than the risk assessment that should have allowed.
Wow. Okay. So that's I just wonder, like, because this chart here, it shows that we're looking at like 20% losses for these collateral, and I'll bring it up again. Looking at 20% losses for the collateral, and apartments were bigger than office, and we know how, we know what office is like, and I guess, are we going to see? So what we're counting on then is 20% of price gains over the next several years, in the apartment market to erase those.
It's not even 20%; it's 25%. Because if you lose 20% of your value, you've lost 20%. So in order to get 20% more, what percent of 20 is 80?
Oh, yeah. Okay. Wow.
So you actually have to increase your value 25% just to get back to par after losing 20%.
What this makes me think is that things aren't over. And, we had a whole, last year we had a whole, a series of reports on distress and on the financing woes of the apartment market, and how maybe this massive increase would maybe create distress, especially with loan maturities for some of those short-term loans coming due in October of 2023. That time passed, and we didn't see it.
And I think this shows you why they did.
Yeah,
because they lost value, and so there was no money.
It's better for both parties if they just ignore that deadline and just wait.
Payments are being.
Yeah. Okay. Well, I guess. Okay. So they're in it together. It's a bad thing if the bank goes. It's bad for the bank and bad for the lender. But
because they don't want to own. They don't want to own properties.
Yeah.
They are in the lending business, just like you said at the beginning of this. We're in the ownership business. We're out in the lending business. They think the same thing. We lend money. We do not want to. We do not want to own these.
I wonder if it's ever going to get to a point where, all right, it's just enough so that it hurts the borrower and not the lender, and that's going to be the time when the banks are like, all right, give me all my money back.
I think we see it a little bit, and I've seen a couple of deals come out where it really happens is though they kind of gave a lot of places kind of gave a courtesy 1 year extension on some stuff. We're kind of getting to that point where, like, I think October was where we saw last year. We've seen it a little bit. A lot of those extensions with the rate drops earlier this year, some people were able to refinance.
Yeah.
Some people haven't been able to, and they're having to bring money into the deals to kind of right size them.
Okay.
To where now, because of those unrealized losses, the people have to bring money in for the lender to keep it on their books, so that way it's less hurt for them.
Okay.
And so you're kind of seeing it where a lot of people for 1 year kind of got a complimentary courtesy. Hey, we'll give you 1 year. But now you're getting to the point where you're going to start seeing some deals coming out because they're just not going to do that anymore. They want the money back, and if you're going to keep it, you're going to have to come to the table with some money in order to keep it.
Okay, no, that's great. That's really interesting. It shows that there's probably some exciting opportunities that are still in the offing for the multifamily market, to say the least. I'm really waiting for things to pick up in 2025, and I think that that adds some fuel to the fire. Thank you so much for coming onto this episode again. I'm gonna see you soon. So, and maybe, again, like maybe it's just you and Spencer, who knows? But this was another great episode. I would encourage all viewers to subscribe to the Gray Capital YouTube channel if you have not, or follow the Gray Report podcast on Spotify and Apple Podcasts. And if you like to read, and if you want a twice weekly update on the latest, greatest, best articles, research reports on multifamily market, commercial real estate, housing, and the economy, you can subscribe to the Gray Report newsletter at graycapitalllc.com/newsletter, and those will come for free in your inbox every week. Thanks again. This was a great episode of the Gray Report. Love to do it. See you next week.